Good morning. Good morning, everybody. It's 10 o'clock on August 2nd. So happy August and happy Tuesday. Almost done the summertime. It's going to go very, very quickly, unfortunately. So good to see you all. I hope you're at a nice place watching this webinar. I spent some time down at the Jersey Shore this weekend and it was nice. We went to a beach, Point Pleasant Beach, and I don't know if I've ever been there, but boy, what a nice little town. So I'm looking forward to going back soon. Today we've got a series of topics. As always, we're going to go over the our Slott updates first. So these are updates that I get from the Slott group. They have a couple of publications every week, and I like to share those with you when they make sense. Sometimes they're way too specific to one industry, for example, but often it's good general information. And I always say that repetition is good. You know, I was reading something at some point in the last week about kind of rewiring your thoughts, and things that we do are very different. Of course, we're focused on tax efficiency. We're even our investment style seems to be much different, but effective. So, you know, we've been taught a certain way in our lives when it comes to saving and investing, and we were taught that it's best to put your money in tax deferred assets. And many of you now know that that's really not the case. There's a prescribed amount you should have in each one of your investment buckets: taxable, tax deferred, and tax free. And also the investment style. We've talked about, we've learned over time, and I've even talked about it and tried to educate people about it early on before I got my head on straight in this, in what we do. You know, we were taught that you can be more aggressive when you're younger, and you become more conservative when you get older, and you adjust your portfolio to have more bonds. And we're seeing the effect of an overweighted bond portfolio. Many people are very down in their portfolios, very frustrated, very upset about it, and very uncertain about what to do. You know, the formula worked for many years, and now it's not working. What do you do? And that fear is a real thing, and particularly in the early parts of retirement. There's that worry zone, I call it, a few years before, and usually a few years into that retirement, you have this worry, this constant worry about, where are my funds coming from? What if this happens? What if that happens? You know, what if I run out of money? What if you know, what if we have a big market drop? What if taxes increase? What if things beyond my control, medical costs? There's all these worries. So, you know, we strive to help folks with that, to alleviate those worries. And I also talk about FOMO, that fear of missing out, because once you get over that worry part, you kind of understand how things are going for some time. And then inevitably you hit this, well, what if we would have invested in whatever hot stock it is at the time? You know, we would have made X of millions of dollars. But, you know, we like to set up our investments so you do have investments that are not only say speculative, but more aggressive for the longer end of your life. But I say all that because these are different ways of thinking. And we're going to talk today in our financial planning section about the break-even point for Roth conversions. I hear this often, so I like to address it periodically, but I'm going to talk about it today because it just came up over the last week or so. And I'm going to show you, you know, really what that break-even, air quotes, point is. And I started this conversation with, I read that, you know, it takes about 11 times to read something or hear something to change a belief. And we've been hearing tax deferred investing, pay your taxes later, you know, don't pay taxes when you don't have to, all these different things for many years. That you do, you know, adjust your investments to more, you know, use that rule of thumb. You take your age, you subtract it by 100, and that's the amount that you should have in bonds. And all that is wrong, in my opinion. And it hasn't worked for many people. So, but these are different ways of thinking. You know, when we do the Changing World of Retirement class, we talk about old paradigms and new paradigms, and that's really a change of thinking. So it's a change of thinking, it's change of belief. And it's easy for us because I started down this road, on this journey in 2012. And so that's 10 years, and I constantly live it every day. You know, many people attend a class, hear a webinar, or watch a webinar, read a book or two, and they're geared up and excited, and then that old way of thinking comes back. They talk to their cousin, brother, plumber, friend, sometimes CPA, and these folks are stuck in the old way of thinking, and they get derailed. So I like to bring these things to you as an ongoing reminder, because it's important. So you may have heard some of these things in the Slott updates. You may have heard some of these things in the financial planning section that we do every week, but it's important for that repetition. So I think everybody should be on now. We seem to have a good sized group. So we're going to move into it. I want to remind you that you are recorded. I hope you're receiving the webinar recording. If you are watching this webinar on YouTube, which people seem to be doing, I have to say, please, you can subscribe, you can hit like, that helps us, and you can then receive the videos as they come. If you want to share these with folks, go ahead, share the link on the website under events and webinars. You can register. I can show you quickly how it's really, really simple to do that. Let me just share my screen here. We're going to be revamping we just redid this webpage a few years ago, but we've outgrown it a little bit. We've got, probably over 120 or so webinars on here. So we need a more dynamic page, dynamic service. And so soon you'll be able to search these webinars and by topic and whatnot. So does everybody see? Raise your hand if you can see my screen now with the webinars. Yeah, good. So yeah, if you know anybody that wants to register for the weekly webinars, join us here live, they can just click here in this bucket, or this bucket in this button here, and it signs them up all the way. And I run it till the end of the year, and then at the end of the year, I'll reset it, and assuming we're still using Zoom, I'll reset it, and you'll continue to be registered. So really, really simple. And of course, if you just want to go through the recordings, you can just page through and see all these recordings we have. It's really, I hope it's helpful to you. So let's get back to today. So today, like always, we're going to go over the Slott updates for about 15 minutes or so. We're going to talk about market updates, and I really don't have any good analytical reports that I found today. There's a lot of discussion about recession. Are we in a recession? Are we not in a recession? We're going to talk a little bit about that. And I told you what our financial planning topic is going to be, and that's going to be that Roth conversion break-even point. Remember on the YouTube channels that if you're watching this on YouTube, there is indexing. So if you go into the section, below, I forget what that's called, but the section below the video, you can actually see where we're talking about market updates, Slott updates, and financial planning. So if you want to click right into that, then you can. And then there's also a link in the video if you want to schedule time with me to review your situation. You can do that as well. Remind you that you are muted. I think we talked about this, but you are muted. Q&A. There's a Q&A at the bottom of the screen there. You can just type in a question as we're going, and I'll answer before the end if I'm able to. And your chat is disabled, and we talked about the recordings. So lots coming up again. We've got Alicia Barnett joining us on August 24th. You should be receiving an invitation for that this week. So that's August 24th at 6:30 p.m. That's one of our special webinars. We haven't had a special webinar since I think March, because we've been so busy we had David McKnight live here in Newtown, Pennsylvania. We had a series of classes, I think 3 classes since then. So we're taking a break from the classes until September. So we're doing at least a special webinar, and I'm still working on that advanced class. That's going to be an on-demand webinar, and I'm trying to find the right platform for that. So we want it to be effective for you. So I don't want to just throw something together. Talk a little bit about the headlines. As I said, there's a lot of discussion about, are we in a recession? Is there a recession, yes or no? So I looked up the definitions, and I like to use, I've told you this before, I like to use resources that you have. So I just Googled definition of recession, and I like Investopedia. So Investopedia, that is just a website that you can access, and has a lot of great definitions of and descriptions of things in the investment world. Investopedia writes, a recession is a significant, widespread, and prolonged downturn in economic activity. Because recessions often last 6 months or more, one popular rule of thumb is that 2 consecutive quarters of decline in the country's gross domestic product constitute a recession, which we've seen over the past 2 quarters. I've been saying, since the beginning of the year, I actually feel like technically we're in a recession. We've been in a recession since the COVID drop, right? Since the pandemic. We've been held up quite a bit from the, making myself a note for our financial planning discussion. We've been held up quite a bit from the federal government, $9 trillion, pushed out into the economy. So that helped tremendously. Of course, we're paying for that now in terms of inflation, significantly high inflation. We're going to be paying for that for many, many years into the future. And we'll talk a bit about that. But folks, we're solidly in the middle of a recession, in my opinion, and there's a lot of reasons why, add on high inflation, higher interest rates. The Fed just is not going to have the ability to lower interest rates anytime soon when we're talking inflation rates at 9.1%. So just feel comfortable with the idea that we're in a recession, and it's always a rear-looking situation, right? They look back and say, oh, yes, we were in a recession over this period of time. Remember, the worst was a Great Recession. So that was the end of 2007, really, until the mid-2009. So that was a long one. And it could be just as bad. I've told you, buckle up here. It could be a year and a half, 3 to 5 years of really choppy, volatile market. We were going to talk about market activity from last week. We got a bit of a lift. We're down slightly yesterday. So far today, we're down about 300 and some points the last time I looked on the Dow. So we're going to see a lot of volatility over the next several years, in my opinion. So another website that gives some good information on basic investment strategies. They can be a little speculative, but Motley Fool, they write, a recession is a period of economic decline signaled by an increase in unemployment, a drop in the stock market, and a dip in the housing market. So we've seen, obviously, a drop in the stock market since the beginning of the year. Unemployment has, the employment market is very strong. So folks who want to work are working, it seems. And we have not yet really seen a dip in the housing market, but I think it's coming. I don't know how that it won't be coming. As you've heard me say, most people buy their homes based on their monthly payment, not on the amount of the house that they're buying. So it's really not about paying $700,000 for a house. It's about the $3,000, whatever that equals to be, $2,500 a month, $3,000 a month in a mortgage payment. But once the mortgage rates go up, and now that is $3,500 a month for that same $700,000 house, well, something has to give because someone's out of the market there, and the housing values will likely come down. Many of you know I'm a real estate investor. I believe strongly in investing in real estate. I've been looking for a place down at the Jersey Shore for an investment property and to use partially for some time, and it started seriously a few years ago, and it's just very quickly becoming not a good market, from my opinion, from an investment point of view. But there's pockets like that around the country, and there's still some good opportunities, of course. But so I think you are going to see the housing market and the real estate market overall soften as interest rates go up. So another organization, now this is a trade kind of email magazine, Think Advisor. They wrote, the National Bureau of Economic Research's Business Cycle Dating Committee rejects the notion that 2 negative quarters of gross domestic product is the definition of a recession. Instead, it looks at indicators ranging from consumption to jobs to industrial activity. There's a quote, there is currently a conflict between the robust growth of payroll employment and the modest declines in some other monthly indicators, said Robert Gordon, a Northwestern University professor and member of the committee. Mr. Gordon doesn't comment on his view of a recession. So there's a contrary point of view. And again, I believe we're in a recession, and we have been since the start of the pandemic. Let's talk about the Ed Slott update. So I'm going to share my screen here with you. Just raise your hand if you can see my screen, please. Okay, thank you. Hello, Tom. So this is about RMDs, required minimum distribution, aggregation, and age requirements of Roth and traditional IRA accounts. So RMDs seem really simple on the surface, don't they? At age, it used to be 70 and a half, and now it's age 72. The IRS tells us exactly how much money you must take out of your retirement accounts at age 72. Technically, yes, it is April 1st of the year following the year you reach age 72, but let's just say at age 72. So there's a table. You can find the table on my website under the Slott corner. It's very, very simple. You can use it, the factor for dividing it, or you can now just multiply it by the interest rate, or excuse me, the percentage that's there. And you would think that it's just very simple. You take your year-end value and you multiply it by that percentage or divide it by the factor, and you have your number. But people mess these up all the time. And they aggregate. This talks about aggregation. They aggregate things that they shouldn't. They take money out of wrong accounts. They think that they think that they can do things that they can't do, and they try to do it on their own. And they get stuck in these ruts. And sometimes it goes on for years until it's discovered. And the penalties on missing an RMD is what? 50%, 50% of the amount that should have been taken out of the IRA. Yes, it's commonly forgiven if it's followed up on appropriately, but there's no need for it. So RMD aggregation, let's go through this. Is from Sarah Brenner, one of the analysts with the Ed Slott group. So the question is, can an RMD from an inherited IRA be taken out of your own traditional IRA? So Jack here is asking, I inherited an IRA and I have to take the distributions from it. But can I take it out of my traditional IRA? I've read that you can aggregate IRAs. Can I just, maybe the situation is he inherited whatever, ABC stock, and it's down 20% because of the market, but his own IRAs have maybe grown, or maybe he has cash in them, and he won't be selling something for a loss. That could be the situation. He says, well, hey, I have an IRA, I'm going to take the money out, I'm going to be taxed. Can I take it out of my own IRA and satisfy the RMD from the inherited IRA? Makes sense logically, but we're dealing with the IRS. So the answer, of course, is, as Sarah writes, hi, Jack, aggregation of required minimum distributions can be complicated, and we get a lot of questions on this topic. You can aggregate RMDs to take the total amount from one IRA in some cases. For example, if you have more than one of your own, if you have more than one of your own IRAs, you can aggregate your RMDs from each and take the full amount from one IRA. So let me pause there for a second. Let's say you have an IRA with us and it's held with custody with Charles Schwab. You have another IRA at Vanguard. These are your own IRAs in your name, IRA, custodian for the benefit of you. So Schwab, Vanguard, and then you have a third at Merrill Lynch, and let's just say they total $1 million. And now you're over age 72, you have to take these RMDs. Do you have to take a little bit out of each one, or the prescribed amount out of each one? No, you can say, okay, the value as of 12/31/2021, for example, was $1 million. I can, Mark, take 100% out of my RMD out of the IRA that you have with you. That's fine. The problem is that when they're not all commonly titled in your name, as Sarah goes on to say, is, however, you cannot aggregate RMDs from IRAs you inherit with RMDs from IRAs that are your own. Really easy way to remember this is the titling is completely different. So it's your IRA, Joe Smith, Jane Smith IRA, instead of inherited IRA. And it would have the person who you inherited that money from. So Dominic Smith, for as an example. So you cannot take the RMD from an inherited IRA from your own IRA. And if Jack's under 59 and a half and he did that, that would lend a whole other issue to this, is that then it would be a premature distribution. He would pay a 10% excise tax on that distribution. So you can really get yourself caught up in this. And what Sarah didn't mention on here, and I think it might come up later, I'm not sure, I don't remember. This includes 401k. So if you're over 72 and you're not working and you have to take RMDs from your 401ks or your retirement plans, you cannot aggregate those with IRAs. That's a big mistake that happens all the time. People say, I have $1 million between my IRAs and my 401k. I want to take my entire RMD out of my IRAs to cover what's due out of the IRAs and the 401k. Let's add to that example I gave you. Remember, there were 3 IRAs, Charles Schwab, Vanguard, and Merrill Lynch. Now let's say you've got a 401k at Fidelity and they all equal $1 million. And I told you before that you could take the RMD out of Charles Schwab if you wanted to, or Vanguard or Merrill Lynch to satisfy all of the IRAs. But 401ks and retirement plans have different rules. So if you tried to do that, you would be violating the RMD rule and you would not be taking the proper RMD out of your 401k, and you would eventually get found out and you will eventually likely have to pay that 50% penalty on that. So you cannot aggregate IRAs with other type of retirement accounts. You can aggregate your own IRAs. You cannot aggregate other type of retirement accounts. Now, what if you have multiple retirement accounts? Also cannot aggregate them. So really, really important. So here's the next question. My wife and I are ages 71 and 69 respectively, retired and not working. Are we eligible to contribute to Roth or traditional IRAs? So here's Sarah's answer. Age is never a barrier when it comes to IRA contributions, not anymore. However, there is a requirement that you have taxable compensation or earned income to make an IRA contribution. I get asked this all the time. I have rental income, I have pension income. That doesn't, Social Security, that doesn't count. It has to be earned income or taxable compensation. Pension and Social Security and rental income is certainly taxable, but it's not earned income. If you and your spouse are both retired and are not working, you will not be able to make an IRA contribution. Good work, Sarah. All right, so here is, let's see how long this is. We'll try to move through this quickly enough. So this is another one from Sarah, just came in yesterday. So 4 things to know about your plan rollover and your RMD. This is a very common issue as well. So if somebody's over 72 and a half, they retire. Maybe they've retired some time ago, who knows? But they have money still in their 401k plan or a 401k plan, and they want to roll it over to an IRA. Why would they want to roll it over to an IRA? Many people want more control over those investments that they have. 401k plans can be restrictive. They do have fees, 401k plans, so you have to look at those. Sometimes the fees in the IRAs can be higher or lower, but you have to look at that. And there's also the opportunity for Roth conversions that we're going to talk about today, from an IRA to a Roth IRA, not likely in a 401k. You can often now contribute to a Roth 401k, but it's very unlikely, uncommon that you can do substantial or scheduled conversions in a Roth 401k. So Sarah writes, many Americans are still working long beyond what has traditionally been retirement age. This may be a choice or a necessity. If this is your situation, you may be keeping funds in your employer plan well into your 70s and maybe even later. This can bring big benefits. You can still make contributions to your retirement account, and you may even be able to take advantage of the still working exception that allows required minimum distributions to be delayed. So if you're over 72 and you're still working, you don't have to if you don't own, I think it's more than 5% of the company. I think that's what it is, more than 5% of the company. So if you're just an employee and you're over 72, you do not have to take required minimum distributions out of your retirement plan. Eventually, however, the time will likely come when you want to take some or all the funds out of your plan. You may want to roll over these funds to an IRA. A large percentage of employer plan funds do end up in an IRA eventually. At that time, you will need to pay special attention to your required minimum distribution, or RMD. If you have one due for the year, failing to follow the rules for your RMD can result in adverse tax consequences and penalties. So let's go up to number 1 here. If you have an RMD from the plan for the year, you will need to take that RMD prior to the rollover. It is not eligible for rollover to an IRA. So if you must, let's go back to the $1 million, and let's say you have to take $36,000 as your RMD for that year, then you cannot roll that over. You'd have to distribute that first, and then you can roll the funds over. And most plans won't allow it, but not all of them are on top of things. It cannot be converted to a Roth. Yeah, it is not eligible for rollover to an IRA. It cannot be converted to a Roth IRA. That's a common question I get. Can my RMD be converted to a Roth? It cannot. The bottom line is that there's no way around it. You must take it. You must take the distribution, and you have to pay tax on it. The first money out of your plan is your RMD if you have one for the year. This is called the first money out rule. And many people run afoul of it. You cannot roll part of your funds over now to an IRA and take the RMD later from the plan. You cannot roll, it feels a little bit like Dr. Seuss. You cannot roll over your entire plan balance to your IRA and then take the RMD from the IRA later. If you do either of these, you will wind up with an excess contribution to your IRA. That can mean penalties if it's not corrected on time. That's just a pain in the neck. You don't want to deal with it. Just make sure you take your RMD first. Like I said, most plan providers, big ones like a Vanguard, Fidelity, they won't even let you do this. They'll push out that RMD to you as a contribution. They'll send a check directly to you, made payable to you, and send a check to either the custodian directly or to you, made out to the custodian for the rollover. But like I said, some of these smaller plans, or if you get the wrong person on the phone, it can be a mess. Your plan RMD cannot, I'm right here, number 3 here. Now, your plan RMD cannot be aggregated with RMDs from your IRA. This means you cannot take it from your IRA. Remember I talked about those, you cannot aggregate these. Also, qualified charitable distributions, or QCDs, are not available from plans, from retirement plans, 401ks, etc. They're only available from IRAs. Once you've taken your RMD, you may roll over the remainder of your plan funds that are eligible. When the rollover funds are deposited to your IRA, they become IRA funds, and we will be subject to the IRA rules. Remember, IRA rules are different than retirement plan rules. Very important to know that. There will be no IRA RMD due for the funds rolled over to the IRA for the year of the rollover. Why? Because you've already been forced to take it from your retirement plan before you rolled the funds over. So you don't have to take it again. It's already done for that year. However, in years going forward, RMDs will be due on these funds just like any other IRA funds. Moving your retirement accounts, your retirement funds can be tricky. This is especially true when there's an RMD involved. If you have questions about your own situation, your best bet to get it right, avoid costly mistakes, consult with a financial or tax advisor who's knowledgeable in this specialized area. So there's only 400 of us, I'll just remind you, in the entire country that take the time and effort and spend the resources and time to be part of Ed Slott's Master Lead Advisor Group. And this constant education, this constant reminders of the rules are part of the value of that. And I'm really happy to share that with you. So I see a question here. Let me just pause for a moment and see who this is. Walter. Hey, Walter. I inherited a Roth IRA. I failed to drain it within the required 10-year period. What is the penalty? It cannot be 50% of the taxes owed because there are no taxes owed. Really good question. I'm not sure about that, Walter. So really good question. So if you currently under the rules, if you inherit a Roth IRA, you have, depending on how old the person was who you inherited the funds from, you either have to take required minimum distributions along the way and then drain it all by the end of the 10th year, or you don't have to take any distributions, and you have to withdraw the total amount by the end of the year, the 10th year, excuse me. That's a really good question. I don't know the answer to that. So what is the penalty? I still think it would be 50% of the amount. It's not 50. You know what? Let's get this right. The penalty isn't 50% of the taxes owed. The penalty is 50% of the amount that should have been distributed. So so let's make it simple. If your RMD for the year is $30,000 and your taxes on that are 20%, as an example, that's obviously $6,000. But the RMD, the penalty for failure to take that RMD isn't 50% of the 6, it's 50% of the 30, right, of what you should have taken. So it would have been $15,000. So simply, I'm glad I had a chance to think this through. If you end up and you have $50,000 left in this Roth IRA that isn't distributed by the end of that 10th year following the year of death, then your penalty would be 50% of what should have been distributed. So that would have been $25,000. And Walter says, by the way, congrats on your 5-star award. Thank you, Walter. I appreciate that. If you don't know, I was awarded, this is from 2020, this plaque here, and this is the 5-star award for 2020. I have a 2021 hanging in my office. And I was notified a couple weeks ago that I've received the 2022 5-star Wealth Manager Award for Philadelphia region. So there's only about, I think that there's about 9% of us in the region who qualified for this award, of all the eligible. So there were only like 3,000 eligible. I don't even know what the number is. It's much, much more than that. But there are 3,000 of us eligible, and only 9% of the 3,000 received the award, approximately. So, and then it's a much smaller number that have received it for 10 years in a row. So I've now received it from 2013 all the way up to 2022. So thank you. I appreciate that. And that's really all. It's based on client service and satisfaction. So that means a lot to me. It's got nothing to do with investment performance or anything like that. It's all client service and satisfaction. So I appreciate that, everyone. Okay, notes. All right, now we're moving into, we're going to go through investments quickly. I'm just going to give you an update, and because again, we spent a lot of time on recession and analyst reports. So last week was a positive week. We had a lot of lift last week, or a bit of lift last week. Dow Jones Industrial Average was up almost 3%, 2.97, still down 8.6 for the year to date. The S&P 500 was up over 4%, 4.28. All the major indices were up for the week, including the bonds. So bonds, the biggest one that's biting most people is that the 7 to 9 year range bond, that what we call the aggregate bond index. So that was up slightly, 0.64%, and it's down 8.16 year to date. But we still have some bond funds that are down more than that. Some of the global bonds are down 17% for the year, 21% year over year. It just stinks. That it's still year to date. Like I said, the SP 500 is down over 12.5%. The NASDAQ is still down over 20%. So it's still a tough year. But you know, we're gonna get little lifts, and I think we're probably in a pretty tight zone right now. I hope that we don't see any more significant declines. Remember, we were down, 40-some% stocks and bonds during the Great Recession. So I don't want to see that again. So that could mean that we're still have a lot of travel down. My humble opinion is I think we're going to be kind of in this range, but I think it's going to be for a while. Like I said, a year and a half to maybe even 5 years. Okay, so now let's jump into our financial planning topic. Okay, so you should see my whiteboard in front of you, and it should read financial planning topic, Roth conversion, break-even point. So raise your hand if that's what you're seeing, please. All right, great. So this is a common conversation, right? People say, okay, I get it. I get the tax value of Roth conversion, but what's my break-even point? So if I convert $100,000 and pay $20,000 in tax, when do I make up that $20,000? So the answer might surprise you, but let's first talk about some fundamentals here. So remember our buckets. We've got your taxable bucket. So this is anything that every year generates a 1099 that's not a 1099-R. So for interest, dividends, short-term gains, long-term gains, you get K1s as well. So, and all of those things equal tax, right? You got to pay tax on that every year. You got to pay tax on interest from CDs. You got to pay tax on interest from municipal, mutual money market funds, long-term gains, short-term gains in investments or mutual funds or ETFs or individual stocks, individual bonds. You pay tax on all those things. So with individual stocks and individual bonds, yes, you can control when you buy and sell them, but still, with most people still invest in mutual funds, and with mutual funds, you have no control over that. So there's a big issue with Vanguard last year with one of their target date funds. People were investing in a target date retirement fund in this taxable bucket, and it ended up with these large capital gains that they weren't aware of or expecting. So that's the taxable bucket. And then you have the tax deferred bucket. And the tax deferred bucket is your, your IRAs, traditional IRAs, traditional 401ks, anything you promise to pay the tax later. Right? You're not paying tax now. Maybe you get a tax deduction going into it, or you don't pay the tax now, but you have to promise to pay it later. So the issue, of course, is what's later going to mean? And we have the I don't know. That should be a question mark. Let me see if I can fix it. And apparently Bill Gates heard me complaining about this new whiteboard because he fixed the fact that I could roll this over now and erase with it like I could before. But the promise, the issue is with this promise to pay later is we don't know what the taxes are going to be in the future. So many of us prescribe to the idea that we have a certain amount of money we want to keep in this bucket. We potentially have a certain amount of money we want to keep in this bucket, and then everything else we want to push over to the tax advantaged or tax-free bucket. Now, there's only two things that are truly tax-free under the tax code, and that's anything Roth. So Roth IRA, Roth conversion. Roth conversion isn't a type of account. It's a process, but that's okay. Roth 401k. And there are some rules. There's a 5-year rule, things like that for when those funds are tax-free. But fundamentally, when you move money from this tax deferred bucket or this taxable bucket, or you make contributions or conversions, they're the only way that you can get money into a Roth, either contributions or conversions. Then anything over here, you never pay tax again. So Ed Slott likes to say you want to move things from forever taxed to never taxed. Really, it's from forever taxed to never taxed again, because once the money gets over here, anything that comes out is 0% tax, assuming you meet the 5-year rule, which is really easy to do if you're over 59.5. The only other thing that's truly tax-free is some forms of cash value life insurance, or as my friend David McKnight likes to call them, life insurance retirement plans. So the idea, of course, is to identify what needs to go here, and then everything else shift over to Roth or the life insurance to have the tax benefit. But we're going to focus right now on the Roth side. So here's where, and we're going to talk about conversions. So they're the fundamentals, right? We identify the buckets, we identify the amounts of money we want to have in each bucket, and then we want to get, the right amount here, the right amount here, and then everything else over to this bucket, whether it's the Roth or cash value life insurance. But focusing on Roth conversions, this is where I get the question. Well, Mark, what is the break even on this? Well, the break even doesn't really exist. I'm going to tell you why. Because here, let's just focus on our two tax deferred and tax advantage buckets. So here's our tax deferred, and here's our tax advantaged or tax free. And let's do some real simple math. So what people are talking about when they talk about the break even is they say, well, wait a minute, if I have $100,000 in the account here, and you're saying I should convert it over here and move it to my Roth, for this example, or in any case, the toll, let's just say, or the cost of going from tax deferred to tax free is, of course, tax. You have to pay the tax on the way over. The Roth conversion is really a distribution from your IRA that the IRS allows, and then a redeposit into the Roth. So it circumvents all the rules about income and all those, the age, all that stuff. They just allow you to do it. So now let's assume, and it's always better to pay the tax out of the taxable bucket if you can, right? But let's assume, just to keep the math, the discussion clear, that you're going to pay the tax via withholding out of the conversion. So we have a 20% tax rate for this example. It's always different. It depends on your situation. This is just an example. Sometimes it's more, sometimes it's less. But let's say we have a 20% tax rate. So of course, this $100,000 we end up with $80,000 in the Roth, because via withholding, we send $20,000 directly to the IRS, never to be seen again, spent as efficiently as the government spends money, right? So that is withholding. That's not unlike what happens in your paycheck when you're working for, anyone. You withhold part of your earnings, and that goes to the IRS every pay period, week, twice a month, whatever your pay cycle is, and you get what's left, right? You get your pay stub, and they would have all those withholding amounts. It's the same when you do a withholding on a Roth conversion. You send that amount to the IRS, and then you reconcile it when you do your taxes, just like doing your taxes are really a reconciliation, isn't it? You either owe more or you get money back. So in this case, we send the money to the IRS. Now there's only $80,000 in the Roth instead of $100,000 in the tax deferred. And this is where people say, well, how long does it take me to make that money up, right? How to break even that $20,000? Well, the answer is it's immediate. The only factor is if taxes are going to be more or less for you in the future. Is your tax rate going to be higher or lower? Because if your tax rate stays the same at 20%, then it's always, these two are always going to run the same, assuming they're invested the same. And you get whatever you can invest in your tax deferred bucket in an IRA, you can invest in a Roth IRA. Now you may invest differently in your Roth. You might be more aggressive, you might be less aggressive, and that would change. But if we're comparing the same rate of return, which you should when you're comparing this, then it really, there is no breaking point. I mean, that is the answer right there. And why is that? Let me show you the math. So let's assume this doubles. So everybody knows, well, you probably know the rule of 72. So let's just say over 10 years, if you average 7.2%, this $100,000 will double. So you've grown this $100,000 to $200,000. Now, assuming that your tax rate is the same, right? It's 10 years later, assuming your tax rate is the same, and you want to take out that $200,000. Well, how much are you going to have to pay in tax? Well, $200,000 times 0.2, right, for 20%, that is $40,000, right? That's $40,000. So $200,000 less $40,000 is $160,000. So after tax, what you'd be able to spend out of that $200,000 is $160,000, assuming your tax rate is the same. Now let's look at the $80,000 that you transferred over here to your Roth. So you've paid your tax. You never had to pay tax again. 10 years goes by, you earn the same amount of return. You average 7.2% over 10 years. Well, you double this and you have $160,000. That's the same, isn't it? $160,000 is the same as $160,000. So the break-even point is immediate, assuming taxes are the same, assuming the investments are the same. So you have control over the investment returns, you really do, by your choices. You don't have any control over the taxes. So really it comes down to, are taxes going to be higher or lower? So that's where the fundamental issue is. Are taxes going to be higher or lower? Because we believe that the average middle-class American is going to be in the 40 to 45% effective tax rate. And we study this on a regular basis. And, we've got good information to back that up. But there are still people who say, well, you're going to be in a lower tax bracket in the future. Well, I don't know anybody that we work with, or I really don't know anybody at all who's going to be in a lower tax bracket in the future because of all the pressures that we have. But we do know there are certain things that are coming that are going to affect this. And if taxes do increase, let's just say taxes only go up, and now you're a little bit, and your tax rate on that $200,000 is 25%. So then if your tax rate only goes up 5%, well, Mark, I don't necessarily agree, or I can't understand that my tax rate would go as high as 40 to 45%. So, okay, let's say it only goes up to 25%. So no longer are you paying 20% tax, you're paying 25% tax. Well, your $160,000 then, of course, becomes $150,000. That's not yours anymore. This is yours. Remember, you have a partnership in your retirement with the IRS. The IRS determines, or Congress determines, how much of that partnership or how much of your retirement accounts you actually own. So if you're fortunate to have $1 million in your retirement account, how much of it is really yours? It might be today $800,000. In a very short period of time, it might be $750,000. In this case, $200,000 goes down to $150,000 in spendable money. What's changed in the Roth? Nothing. You still have $160,000. Let's say your taxes go up to 30%. Well, now this $150,000 isn't yours. Taxes are now 30%. Now you have $140,000. Taxes have gone up, now 10% for you. What's happened to the money that you converted to the Roth? Hasn't changed, stayed the same. So now let's just say that we hit our 40 to 45, and I actually did 42.5, but let's just assume 40 to 45 effective rate. Now that brings you down to $115,000. So you got to pick one, folks. So who do you trust? Do you trust your own ability? Do you trust the people you work with? Where's my green? Because this 160 here, oh, that's fancy. That's going to stay constant. We're certain, and I think you are too, that taxes are going to increase. So your $200,000, the only way that there is this break-even question is if you have to assume that you never pay tax coming out of the IRA. Now, there is a way to do that but it's dependent on your situation. But for most people, well, for many people, you're always going to pay tax on the money coming out of your IRA. So the answer to the question, when is the break-even point? It's immediate, dependent on the future of taxes. Now, you might say, well, Mark, I don't know, do taxes really have to go up? Let's explore this. So stay with me. I know we're past the 10:45, but stay with me. So I showed you the math. We talked about the fundamentals. So the next question is, will taxes increase? So I've got some information here. So the first thing I'm going to show you here is our 2022 chart. I hope you can see that. And the 2017 tax planning chart. So why am I showing you the 2017 tax planning chart compared to the 2022? Because in 2025, 12/31/2025, this goes away and we go back to this. That is the sunsetting of the Tax Cuts and Jobs Act. We are currently operating under the Tax Cuts and Jobs Act of 2017. That sunsets 12/31/2025, and we go back to this tax table here. So someone recently said to me, the CPA for a fact, they said, I don't know, I don't think this client should do Roth conversions because they're going to be in the 12% bracket, for the rest of their lives. Well, in 2025, the 12% bracket actually doesn't exist. So these are the things you actually have to look at. Now, so this is legislated. The Congress has to do nothing for this to take place. And if they do something between now and 2025, it's probably going to make this worse. Now, so the 12% bracket that we have now, I know these are hard to see side by side, especially because these are slot tables and they've inverted. They've changed the direction of the taxes. But the 12% becomes 15. So this goes away and that becomes 15. The 22 goes away. That becomes 25. Let me see if I can draw these a little clearer for you. I don't like this color. Let me see if I can change this. I don't even know where this color came from. Let's see. The 22 becomes 25. The 24 becomes 28. The 32 becomes 33, 35, 35, and 37 becomes 39.6. So you can see the most affected ranges are in the middle here. So let me erase these because I want to show you something even more important here. And that's the amount of income. So I hope you're following on this. because not only do we, or is the biggest effect in these middle brackets, middle-class American, this is what I'm talking about, while middle-class America has to be in the 40 to 45% effective tax rate. The biggest changes are here, aren't they? So the from the 12% up to the 32%, or really up to the 24%, we get the biggest jumps because it goes from 15 to 28. So just from a marginal tax rate, it gets much higher. But look at the income. Just one example, the top of the 24% bracket this year is $340,000. Let's look at the top of the 28% bracket on the 2017 rates. Well, it's $233,000. Adjusted for inflation, I'm thinking that's going to be about $262,000. So that is $100,000 difference just about from where we are today. Actually, yeah, $120,000 difference from where, I'm sorry, I guess just about $80,000 difference from where we are today compared to where we're going to be, and we're going to be at 4% higher. So my point is, you're going to hit those higher marginal tax rates much, much faster. So legislation is one thing. So we've got legislation that's going to happen, folks, unless Congress intervenes between now and 2025. And if they do intervene, it's likely to be worse. Don't forget the Congressional Budget Office said our tax rates have to be really simply like this. Right? 25%, 62%, and 88%. That's what the Congressional Budget Office said. So, they're frightening numbers there. So we're well on our way just legislatively. So taxes have to go up just by legislation alone. Now, why else may taxes go up? Let's look at some other reasons here. So I'm just trying to scroll down here. See if I can get some help with my mouse. I see what's happening. I'm going to turn that off. No. Okay, I'm getting some. So Bill Gates needs to pay attention again because I can't quite scroll here. Stay with me, everybody. I think that's the one I want. Okay, there we are. All right, so this was interesting. So this is from the Peter G. Peterson Foundation, and this was put out May 31st. So interest on the national debt is a big one. We're seeing interest rates go up. We've been talking about this. Our not only is our national debt going up, but our interest is going up, and we must pay the interest on our national debt. We can't not pay our interest, and we can't not pay our debts because then we'll have a sovereign debt crisis, and no one will want to invest in the U.S. and our monetary structure will just crumble. So this organization, the Peterson Foundation, had this really great article, and it talks about interest costs will reach historic highs within the next 10 years. The Congressional Budget Office, CBO, projects that annual interest costs will rise from $399 billion in 2022, right, to $1.2 trillion in 2032. As a percentage of gross domestic product, or GDP, those costs would double from 1.6% of GDP to 2022 to 3.3% in 2032, which would be the highest level ever recorded. Interest costs are now projected to be significantly higher than the Congressional Budget Office calculated nearly a year ago, just over a year ago. Folks, it's going to get worse and worse and worse. It's going to compound and likely to get worse. Over the 2022 to 2031 period that CBO reported on last year, the agency projected the interest cost would total $5.4 trillion. Rapid inflation and higher interest rates have boosted that projection by $1.9 trillion, or 35%. Over the current 10-year period from 2023 to 2032, interest rates would total $8.1 trillion. So that is a nonpartisan group, the Peter Peterson Foundation. You can look them up. If you look at the board of directors, they represent really just a broad brush of different experts from different political parties. So now we've got legislation, right? Legislation says taxes have to increase. Our national debt says taxes have to increase because there's only really one place to get this revenue. There's small little other places where revenue comes in, but it's mostly from us, the taxpayers. Now we look at, you've heard me talk about the 2022 Social Security and Medicare Trustees Report. So to make it really simple, this is Social Security. The year trust fund reserves are depleted, 2034. No more money in the trust to pay Social Security by 2034. That means only a portion of the benefits are payable to folks who receive Social Security. Nobody is going to accept that. Nobody's going to accept that. This hospitalization insurance is Medicare. The year trust fund reserves are depleted for Medicare is 2028. If that's not right around the corner, I don't know what is. That's why we say you've got to do everything you can to get your tax efficient strategy done by 2030. If you have to go a few years beyond that, you know, we can manage it, but ideally we want to get it done by 2030. So we have Social Security and Medicare. We have legislation. We have the national debt. The other thing, going back to, and some people still say, with all this evidence, some people still say, I don't know. I don't know, Mark. You know, somebody somewhere is going to find a solution to this. I don't know what it is. I don't know what it could be, but, you know, somebody will figure it out. Well, one thing I can tell you for sure, even if you don't believe all that evidence, if you go into retirement as a married couple, let's look at what we have here today. Now, my green pen's not back. What's certain is that one of you is going to die before the other, nearly certain that one of you is going to die before the other. So look at the change in the tax rates for a married filing joint couple and a single person. Look at the difference in income, 22%, $83,551 to $178,000 drops to $41,776 to $89,000. That means that as soon as you cross over $89,000 of taxable income, you go up into that portion, right? That's over $89,000 goes up in the 24% bracket. If you want to maintain the 12% bracket during retirement, if you can, you're at $20,551 to $83,000, pretty generous for 12% under the current rules. That drops if one of you passes to $10,276 to $41,775. You know, and once we get to 2025, of course, the numbers are much worse. We're back down here, 15%, right? Because 12% is gone. If you're married filing jointly, you got from 18,651 under the 2017, that'll adjust for inflation to 75,900. But once you're single, you top out at the 15 at just 37,950. So even if you don't believe all the evidence, you have to assume if you're together in retirement and you're both 65, 66 years old, that you better die at the same age, or your taxes or you're at the same time, or your taxes are going to be much higher for one of you. So I hope that helps. Again, if you're watching this on YouTube, hit the subscribe button, hit the like button. If you know people who should join our webinars, you can tell them that they can register. What I've shown you here is that this is a myth, really, this break-even point. There is no break-even point, assuming taxes are going to be the same or higher. And I don't see evidence of why taxes would stay the same or be lower. So for most people, it makes sense to take a look at Roth conversions. I hope that was helpful. I do have a question. Let's see what the question is here. Furthermore, Walter says, the Roth may have additional advantages for Social Security taxations than IRMA. Yes, we're going to talk in the next couple of weeks about Social Security taxation, and we're going to talk about IRMA as well. Thank you, Walter. It's just too much to talk about this. I'm obviously very passionate about it, but there is no break even, assuming taxes are going to stay the same or go up even slightly, even by 1%. Still, that break even doesn't exist. And I've highlighted just a few reasons why taxes have to go up significantly, if not double, within the next 10 years. So thank you, folks. I hope you enjoyed it. If you have any questions, thank you, Kathy. If you have any questions or need time with me, please reach out, and we'll see you next week. Take care.